Hey dividend investors, today I am going to be breaking down the differences between SPY the ETF as well as VOO the ETF. They seem pretty similar, so let's go check them out and see which one is really the better deal. Okay, so the ticker symbols for these is obviously VOO and SPY. SPY is the more popular ETF out of the two. However, let's see which one is actually better. As we can see, the Vanguard is at 351.90, SPY is at 382.88. So technically, if you're buying a lot of shares, you may be able to squeak out a couple of more shares of the Vanguard ETF, depending on how many, of course, you are buying for whatever set amount of money that you are using. From there, we really want to see how much it's gone up, let's say today, as of the market close. And of course, we see that they are basically down roughly the same percentage-wise, but of course, because this one is a higher dollar amount, this one is down farther when it comes to dollar amount, but percentage-wise, it's essentially the same. From there, we really want to look at the net assets. Which one is actually bigger? And the Vanguard one is bigger. It's almost double the size. This one has $637 billion for assets, while SPY has $329 billion in assets. From there, we want to look at the yield. And the yield on the SPY is 1.52. And under Vanguard it is 1.54. So as of right now, technically speaking, if you are looking as a dividend investor, Vanguard is the better option for that 0.02%, which in reality, depending on who you are and how much you're investing, may only be a penny or two or more. Then I want to look at the expense ratio. How much does it cost to hold the ETF? Because ETFs, even though they are electronically traded funds, it still costs money for you to invest in them. And for VOO, it costs 0.03% every single year. So let's say you had $100 invested, it would cost you somewhere around 3 cents. While if you had $100 invested in SPY, it would cost you 9 cents. Now, when you're only talking about $100, it's not a lot of money. But when you start talking about $10,000, $100,000, or maybe even $1 million, that starts to add up quite quickly. From there, we want to see when they were basically started, and VOO was started in 2010. SPY was started in 1993. So this gives us a little bit more price history on SPY. Let's keep in mind that both of these are index funds or market funds or whatever you really want. Everyone has, it seems like, a different way of calling it, but I basically call it a market fund. It mirrors the market. And from there, we also want to look at the volume. And the volume on SPY is much higher. That's because it is more popular. Let's face it, it's literally on CNBC every single day under SPY. It literally mirrors the market. And when it comes to the volume, both are healthy. If you want to sell either one of these funds, you're probably going to be able to get out of it, even if it's a selling day. Because when you're talking about millions of shares traded every single day, that adds up, and it's very liquid. You're able to get in and out quite easily. We have the average volume of 3.2 million. Meanwhile, with SPY, it has 70.5 million shares. Now, altogether, I would prefer VOO over SPY, mainly because I would be holding it for a long amount of time, and that expense ratio is going to be a massive factor. Also, that 0.02% could be a little bit of a factor for me. Not so much, but for others, that could be a massive factor. For VOO, the starting price was $101 back in 2010. It is now $336. It has gone up 330%. From there, roughly around that same time, it's gone from 114 for SPY up to 382. So roughly the same. These are both mirroring the market anyways, right? So does it really matter? So how I would look at both of these funds is essentially how I would personally trade them. If you're looking to hold it for a long amount of time, VOO would be the way to go. If you're looking to day trade it or just to get in and out quickly, I would look at SPY because there's more volume being traded, but also I would be looking at SPY for options. That's how I would be looking at it. Anyways, I hope that this video has basically explained both of these ETFs quite well. They mirror the market, and of course they both have very low MERs. I hope that you've enjoyed. If you have, hit that like button, subscribe. I'll see you guys again next time.